Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, in part 2 of a 3-part series, Paul speaks with Alan Scharfstein, president and founder of the DAK Group, a 30-year-old middle market investment banking firm, about the needs and prospects of middle market owners considering a sale or recapitalization.
I'm not quite sure how educated a lot of owners are about the concept of a recapitalization, whereby, the phrase "taking a second bite at the apple" comes in. Where you can take some money off the table, you can diversify your personal wealth, and yet maintain a stake in the business and continue running the business. Is that becoming more accepted, or perhaps it's always been widely accepted? I don't know. But given the circumstances that you just described, I would think that would be a very attractive thing for the 49-year-old to take advantage of. What do you think?
Oh, you're absolutely right. This is, for younger owners, sometimes the best of all worlds. It really allows someone to possibly hedge their bets, take dollars off the table, but not really exit the business. And I think that is a very attractive option for certain business owners. It also allows them to do certain other things. Besides taking the dollars off the table, it allows them to fund the expansion of their business or the growth of their business without doubling down on their risk of investment in their business. So when you put those things together, it really becomes a very, very attractive scenario for certain people. The other thing that is often brought to the table, for example, if you are doing one of these partial exits, often you are also bringing into the company at that same time more than just dollars. You're bringing in certain expertise to help you build your company to the next level, understand how to grow it in a different way, develop the expertise to do acquisitions, to be better funded so you can take certain risks or take advantage of some opportunities that you might otherwise not be able to take advantage of. So if you combine all of those options together, that can be a very, very attractive opportunity for someone who is too young to retire, wants to take some money off the table, thinks it's a really opportune time in the marketplace, but doesn't really want to fully exit the business.
Now, is that the kind of thing that, because you had mentioned previously the amount of money sitting in private equity funds right now, and that's, from my understanding, that's a pretty hefty chunk of dough. And there's also a lot of money on the strategic side, but that's a little bit different. Usually, it's, as I understand it anyway, it's typically private equity firms that are doing, these recaps, whereby they buy a controlling stake. The owner gets to retain a certain amount, and the owner continues to run the business. I would think that the fact that there is that money on that side, and the ability to maintain sort of a consistency of management and strategic vision would be a pretty attractive thing on the private equity side as well. Or am I misreading that?
No, you're absolutely on target. The private equity firms love situations where management wants to stay on board, has faith in the business, has a plan to move the business forward, and what they're lacking is potentially some dollars and potentially some expertise to do that. The fact that you have ownership that has skin in the game, that continues to be dedicated to the business, is an essential element of the formula that private equity firms believe are necessary for them to be successful in an investment. So if we have those various characteristics surrounding a transaction, odds are it's going to be very attractive to the private equity investors.
Sure. Now, when you deal with a lot of owners who have obviously a variety of desires, plans, etc., and certainly a lot of quirks, because that's just the nature of this marketplace, isn't it? I guess one of the challenges, and I've run into this with a couple of owners that I know that have gone through that very thing, and the only complaint, sure, they like the liquidity they get. That's a great thing. They like to be able to still be in the business and push their dream forward. But one of the downsides that they always identify is that they're not used to dealing with a partner, particularly a controlling partner, in terms of the kind of requirements that a private equity firm, for instance, would put in place. I mean, obviously, private equity firms use leverage, and there are certain milestones that one has to hit, and there are certain ways of doing things. I mean, do you see that as sort of being a significant downside, and sort of how do owners deal with that in your experience?
It's a great question. One of the challenges, or one of the objectives that a investment banker should have in dealing with a client and trying to understand the options that are available, is really explaining to those clients what the pros and cons of all the different investment and exit and acquisition options are for a business. Not every business owner is meant to have a partner. And for those who aren't, there are certainly options available that make a lot of sense. Those, for example, may be better off selling a business to a strategic who is going to combine it with another business and allow the owner to exit that business quickly with a lot of cash in his pocket, but exit it quickly because it would be too straining on that owner to be part of a larger organization. What you find in transactions, and we do a lot of work following up with business owners post-transaction, talking to them what are the best things of the transaction and what are the most frustrating aspects of the transaction. The single most frustrating aspect of a transaction for a business owner who is used to being an entrepreneur and is used to reporting only to himself is the fact that he has to report up instead of just reporting down. In the past, when a business owner owns a business independently, he would make what he felt were the right decisions for that business, implement them, and deal with the positive and negative aspects of those decisions. The fact that that business owner now, with a controlling partner, has to explain why he is making a particular decision and what that investment thesis is often a very frustrating process for him, especially when decisions are not made on an immediate or an expedited basis. And sometimes those quick decisions were the key to a business's success. So you really have to look very carefully at whether you are picking the right solution for a business owner, number one. And number two is really picking who that partner might be, because there are different partners, even among private equity firms, there are different approaches to business, to independence, to decision-making processes. And this, very much like a marriage, it involves picking the right party, and marrying rich is not always the right solution. So sometimes picking just what appears to be the highest number is not necessarily the best decision.
Be sure and check back tomorrow for part 3 of our series. Thanks for listening.